Hi, so let's continue the deep dive company analysis of Markel. In part one, I went through how I firstly research a company and where I find the information. I also started working through my investing checklist, and the first section of my checklist was the industry analysis. And today we move on to the competition analysis, and this is what Buffett would call the moat. For those of you who are new, well, watching these videos in order is probably a good idea, but hey, it's your YouTube viewing time, so do whatever you like. If you want to start here at part two, then great, I'm just happy you're here. Now, the checklist that I'm working through is something that is evolving and will continue to evolve throughout my career. I base a lot of my knowledge on the great investors, Peter Lynch, Warren Buffett, Charlie Munger, Monish Pabrai, Phil Town, and a handful of others. The company that I've been examining in detail is Markel, which has been described as a mini Berkshire Hathaway. This is the second section of my checklist. These are the questions I want to answer to make sure I actually do understand what I'm researching. If I can answer these questions confidently, then I can move on to the next part of the checklist. The checklist is great so I don't forget anything. I'm pretty forgetful, so this helps me a lot so I don't miss anything. Okay, so the first item on this checklist is the brand. So I'm going to see if the brand is really important to sales. For example, Apple is a really good example. Everyone uses Apple, I know, but look, the brand of Apple is really strong. I'm in here in Ukraine, and even though the average wage is like $500 a month, everyone has an Apple phone because it's a status symbol. So that's very important to sales. The second thing I look for is if it has a switching cost. So is it hard for the customers to switch, or is it painful? An example here would be something like Dropbox. So yes, there's Google Drive and other services out there, but once you've sort of got into Dropbox and you've got all your files in Dropbox, it's quite painful to move away from it. So look, I would say there's a switching cost for Dropbox. Then I'm looking for a toll bridge. This is what Phil Town would describe as like a company that has some sort of monopoly or near monopoly. For example, China Cord Blood Corporation, which is a company that I've investigated. It's a Chinese umbilical cord company. Well, the government rules, there's provinces in China and they are allowed to operate in 3 of the 7 provinces without competition. They're only allowed to have 1 umbilical cord storage company per province. So the government rules has made it a monopoly in those areas. The next competitive advantage would be a secret of some kind. So a patent, a formula, a recipe. Well, Qualcomm, for example, has lots of licenses, and a lot of the phone manufacturers have to pay Qualcomm to make phones. KFC has the recipe, so things like that. Some businesses have price as their competitive advantage, so maybe they can be a low-cost provider and they can be lower than everybody else and sustain it. For example, Costco in America, they can sustain their low prices, whereas Virgin Airlines, when they move to Australia, they put their prices down crazy low, like $5, $10 a flight, to gain as much market share as they could, but that's not sustainable. Then I check to see if they have some sort of niche. A good example here is the Yeti Eskies, the cooler boxes. Yeti is a very good brand, and they have a sort of a niche on the upper end storage cooler market. Now I check to see if the moat, or this competitive advantage, is durable. Will it get wrecked by something in the future? So this is a bit hard to think about because you've got to think of the future. But for example, Sears got crushed by online shopping. The taxi industry is getting crushed by Uber and new technology. So we're trying to think of, is there something that we can see in the next few years, maybe next decade, that's going to completely revolutionize? It's probably already happening, but we can't predict everything, obviously. Then I check to see if it's super hard or expensive for someone to start competing. A really good example here would be Boeing. Now, to make airplanes and have the infrastructure to do that is going to just cost billions and billions of dollars. It's just too hard for a startup to get going into that space building airplanes. So Boeing has a big moat around it because of that. The next question I ask myself is, will a cheap country come in and undercut them on price because they can pay cheap labor? This is pretty much anything to do with manufacturing in this case. And the next question is, I write down who are the competitors, and does the company that I'm investigating, do they compete directly without a point of difference? So I'm just listing the competitors here. Then I ask myself, do customers have to keep buying from them? Like, do they have recurring revenue streams? Look, Dropbox is really good with this because if you don't pay, well, you're not going to have access to your files, so you do have to keep paying. Okay, so the next few questions are about the metrics that we find in the financial statements. The first one we're going to look at is the net income, and we want the historical growth to be over 10% per year. We look at it over the last few years and the last 10 years. Now, the reason we look at net income, not earnings per share, is because if the company is doing share buybacks, well, that's going to affect the earnings per share, But net income, well, that's not related to the amount of shares that are out there. Then we go look at the book value historical growth, and we want that over 10% per year. We look at the last few years and the last 10 years as well. Then we go look at sales, and we want the historical growth over 10% per year. Again, the last few years and the past 10 years. Then we look at operating cash and its historical growth, and we want that also over 10% over the last few years and the last 10 years too. The next thing we look at are the gross margins, and we want them above 50% if possible. Look, good gross margins mean that the business can use a lot of their money, like they have a lot of buffer for new ideas, new expansion, new products, things like that. And we want to see then if the gross margins are improving, because if they are improving, well, it's actually a really good sign that they have a competitive advantage. It means they can raise prices and still be making a lot of sales. Okay, now the next thing we need to do is try to estimate some sort of growth rate for the future. For the next 5 years is what our goal is here. So we actually check analyst information from Yahoo, Zacks, anywhere else we can find, and see whether it looks like the business is speeding up or slowing down. Look, we have to take the analyst's opinion with a bit of a grain of salt here, because look, they're trying their best to work out what the future's like, but no one can predict the future. We can also take our own estimates by looking at the past, those growth metrics from like net income and sales and things like that, and see how that might continue for the next 5 years. So this is more of our own opinion too. And the last question on the checklist today is, how well did the company perform in the last recession? So we just go back in time and have a look how they went. Now, we don't have to say yes to everything on this list. That would be impossible. These are just the questions I'm asking myself to see how well I know the company and to look for red flags. For example, if I can't clearly identify the competitive advantage, well, that's a problem. Okay, now since the last video, I have now completed reading the 3 write-ups on Value Investors Club about Markel. That took maybe about an hour. Now, I read the Saber Capital report as well, which I'll leave a link in the description, which took about another hour. I watched maybe 3, maybe 4 hours of interviews from Tom Gaynor, who's the CEO, plus I have bounced the idea off another investor about the company. Okay, so maybe I've spent 5 or 6 hours in total research mode here. That might seem like a lot to some people, but if I'm going to potentially invest tens of thousands of dollars of my hard-earned money into this company, well, I just think that's time well spent. Now, also, some companies will be much easier to research because you will already know the company. For example, Amazon. You probably shop at Amazon a lot. You are familiar with Jeff Bezos and listened to him speak about Amazon a few times already. You probably don't need to do much research on Amazon compared to what I'm having to do for Markel. So my advice would be, if you are relatively new to investing, stick to the companies that you know and already understand. That is just going to be a bit easier. Something I want to add here is that you'll never know everything about a company. And that feeling is actually really normal. My theory on this is that I do my checklist, and if I invest, I do a small investment size to start. It gives me time to learn more about the company. Now, once I am invested, my motivation to research and learn about the company definitely improves. So from there, I learn even more. And there has definitely been times where I've actually backed out of an investment because I researched so much and I found some red flags. And that's not a problem at all. I think it's actually a good thing. And then there are times that I researched more and found that the company is better than I even thought originally. So then I add even more to the position. Okay, now let's get back into Markel, because this is a company I knew nothing about, and it's a great example of how to start at zero knowledge and work your way through to a decision. And now what I'm going to do is attempt to answer as many of the questions on my checklist as I can for Markel. Okay, the first question is the brand. So Markel doesn't really have a brand that means anything, I think. Based on my reading, they have strong customer loyalty, so customers in these hard to place risk categories know Markel is one of the largest and most secure counterparties in their markets, but I don't think they have a powerful brand. Nothing like Apple or anything like that. Now let's see if they have some sort of switching costs. Now, insurance is practically a commodity. If someone else was to come along and compete in the niche markets, well, they could just offer better prices. I don't think the switching costs exist as a barrier at all. Then we see if they have some sort of toll bridge, and look, they definitely don't. Insurance is practically a commodity. Okay, then I go see if they have some sort of secret, a patent or a formula or something like that. And look, they do have many years of experience in pricing these weird niche industries. So they have data that would take years for other competitors to build up in these areas. So yes, I think they have a formula moat, and it's quite a strong barrier even for other big established insurance companies. The next question is, do they have a price moat? And look, insurance is a commodity like I've already said, so no, they don't. The next question is, does it have a niche? And yes, this is definitely a strong moat that they have. Most insurance companies don't write the niche products that Markel can write. So this is definitely the moat that they have carved out that will be difficult for others to cross. It's not impossible, but definitely a barrier. So is the moat durable? Will it get wrecked by something in the future? Well, most likely. AI insurance products will affect the industry. Luckily, the niche insurance products that Markel deals with will be far more difficult for AI to penetrate. In the meantime, companies like Lemonade, for example, that are innovating in the insurance space won't probably venture into the specialty insurance world because it is just too difficult and requires decades of data and experience. But it isn't impossible, and it will just take longer. Lemonade can go after the low-hanging fruit of like car insurance and home insurance and things like that first, I think. Now, the next question is it super hard or expensive for someone to start competing? In insurance, well, no, not super hard at all. But to be as profitable as Markel will take a lot of time and data. So will a cheap country come in and undercut them on price because they can pay cheap labor? Well, no, this is an intellectual product. Cheap labor doesn't really affect this company. Okay, so now I'm looking at the competitors and whether Markel compete directly or they have a point of difference. So there's companies like Arch Capital Group, American Financial Group, Navigators Group. Actually, the list is really long here. All insurance companies are competing in probably one of the most competitive industries in business. But Markel has a few points of difference. The points of difference are they're in niche insurance markets and it has specialized expertise in the space, and the company has superior investing skills. Tom Gaynor, the CEO, is a high quality value investor, and Markel allocates a large percentage of its shareholder equity into the stock market, more than most other insurance companies. We'll get into that in more detail about the management further on in the checklist. That's actually the next video. Now, the next question we ask ourselves, do customers have to keep buying from them? And in this case, no, they don't have to. Now we look at those growth metrics. So we're firstly looking at historical net income, and net income and earnings per share for the last few years in insurance and financial companies is reported differently. So this isn't a good measure for the industry. This is important for most other companies, but in this case, it's actually an exception. Then we go look at the historical growth of their book value. Now, as you can see, since 2016, book value has grown at about 9%. And since 2010, book value has grown at about 15% per year. So that's definitely a pass mark. Then we go look at the historical growth of their sales. And as you can see, since 2016, revenue has grown at about 19% per annum. And since 2010, it's grown at about 17.5%. And these are great results. I would love a company that can do this for such a long period consistently. Now, regarding historical operating cash, like we have seen in the previous graphs, a great trend over the last 10 years. Nothing dramatic, just solid growth. Since 2016, operating cash flow has grown at 32% per year, and since 2010, at about 21% per year. Just great signs here of a great business. It is looking like a compounding machine. Okay, next point on my checklist are those gross margins. Now, we don't actually have gross margins here for an insurance business. This is more for product-based businesses like Sprouts Farmers Markets and Apple and stuff like that. Now that kind of rules out question 17 as well. So no, they don't report gross margins for the insurance company. So we just move on. Now the next thing we look at is try to get an estimate of the future growth rates. So what we have been doing in the last few questions is looking at the metrics for the growth rates. And my feel so far would be the low end range of 10% growth per annum from now on. And the high end is probably 20% per year. Now I'll go and check Yahoo Analysts and Zacks Analysts opinions. And Yahoo is just saying that the next 5 years is going to be minus 3%. Look, I have no idea where they're pulling this from. There is no indication so far that I've seen negative growth is going to happen, but it is very interesting to see such a dramatic number compared to the historical performance. I went and checked the Zacks website as well, but they don't actually have an estimate here, and sometimes you'll see that. It's because the company is small and not really followed by all of the analysts. Now, the last question is how well did the company perform in the last recession? And as you can see here with the equity graph, the company dipped a little in 2008, but no real major issue here. The business is made up of two areas, the insurance side and the investing side. Both of these I see as a competitive advantage. Markel, I think, has a strong moat in an insurance industry that is really difficult to have a moat. The moat is that they are strong in specialty insurance, and this takes decades of data and experience to get good in this space. The second moat, or competitive advantage, is they have been investing their float into the stock market. Although this comes with added volatility, it also comes with superior returns if done correctly. And based on the historical growth rates of the business, it would appear that the company has been able to consistently perform over a long period of time. And that's the type of compounding investment history that we really want to see. Now, this leads really nicely into the next video that is all about how good is the management team, what are they actually investing in, and do we agree with their investing style? So here are all the 19 questions that I asked myself today. You can have these, by the way. I hope you follow along with me as we analyze this company together. I would actually really love to hear more points that I could add to my checklist, and maybe you have your own checklist. Look, I highly recommend having one. It will help you feel so much more confident in your investments and will help you make good decisions. Something we can all improve is our decision making. Don't forget to subscribe so you don't miss my future videos, and I will see you soon for part 3.